Picture this, you're sitting at your kitchen table, coffee steaming, and the ticker scroll on your phone flashes a 70+ price on AMD, a 250+ on ARM, and a 75+ on MU. You glance at the news, see a headline about a potential peace deal that could calm markets, and suddenly you wonder, have I just bought a ticket to a roller coaster that's already at the top? That feeling, that mix of excitement and a tiny knot in your gut, is exactly why we need to ask what's really happening with the memory chip names that have been driving the tech rally for months. My thesis is simple. The three memory giants, AMD, ARM, and Micron MU, have become overextended. Their valuations have risen faster than the fundamentals that justify them, and we are looking at a probable pullback. At the same time, Adobe, ADBE, just dropped a revenue beat that lifts the top line 13%, while the stock slides 23% this month, creating a different kind of opportunity that leans more toward income and a measured entry. If you understand where the risk is and where the cushion lies, you can keep your money safe while still staying in the game. First, let's unpack why the memory names feel stretched. The semiconductor sector has been riding a wave of optimism powered by AI hype, data center demand, and the promise of faster, cheaper chips. AMD's share price has jumped from roughly $30 at the start of 2023 to over $70 today. That's a 133% gain in just 3 years. ARM, still privately held but now publicly traded through a SPAC, vaulted from a $150 valuation to more than $250, a 67% rise in under 12 months. Micron, the pure-play memory maker, surged from $30 to $75, a 150% climb. Those moves look impressive until you line them up against the underlying earnings growth. AMD's trailing 12-month earnings per share, EPS, grew about 30%, ARM's revenue grew 20%, and Micron's EPS is barely up 10%. The price-to-earnings PE ratios are now in the high 40s for AMD, the high 60s for ARM, and the mid-50s for Micron, numbers that are historically reserved for the most speculative growth stories. Now, add the macro backdrop. The VIX, our fear gauge, is hovering at 16.9, low enough to suggest complacency, but still higher than the ultra-quiet levels of early 2022. Oil sits at $75 a barrel, keeping inflation pressures modest, while the 10-year Treasury yields sit at 4.45%, giving a decent real rate floor for bonds. The Fed is sitting on a hawkish tone, keeping policy rates between 3.5 and 3.75%, and not hinting at cuts until 2027. In a regime we call neutral, equities need to justify their premiums on earnings and not just on hype. When you combine a relatively high cost of capital with a market that's already priced in a lot of future growth, the math starts to look uncomfortable. What does that mean for the memory stocks? Imagine you bought AMD at $70 because you believed AI would keep demand for its GPUs soaring forever. The next earnings call shows a revenue increase of just 8%, while the broader AI chip market is growing at about 12% annually. The gap between expectation and reality widens, and investors begin to adjust. Historically, when a high-growth name starts to trade at APE above 40 and earnings growth lags behind, the price tends to correct by 20 to 30% over the next 6 months. In AMD's case, a 25% dip would land you around $52, still above the 2023 level, but a meaningful reduction in the cushion you had built. ARM tells a similar story, but with a twist. Its business model is licensing, which gives it a high-margin profile, yet the licensing revenue is still tied to the semiconductor cycle. A slowdown in device shipments, which we already see in the smartphone market where shipments are down 5% YOY, directly trims ARM's top line. The market's current price assumes a 30% growth trajectory for the next year, a number that now looks optimistic. If you run the numbers, a 20% price drop would bring ARM back to roughly $200, aligning the PE closer to the sector average of 30. Micron is the most vulnerable because it's a pure-play memory manufacturer. Its margins are highly cyclical, moving with supply-demand imbalances in DRAM and NAND. Right now, the inventory levels at major OEMs are at the high end of the 12-month range, suggesting a potential oversupply that could pressure prices. The recent earnings showed a 5% decline in DRAM pricing year-over-year, while Micron's EPS slipped 8%. A 30% correction would take the share down to about $52, which is more in line with its historical valuation during the last memory boom. All that sounds like a warning siren, but there's a catch. Even if the prices pull back, the underlying secular trend for data center demand and AI workloads remains strong. The question becomes how to stay exposed without getting burned. One disciplined approach is to scale in gradually as the price falls toward key technical support levels. For instance, AMD's 200-day moving average around $55, ARM's around $190, and Micron's around $50. By entering in smaller tranches, you preserve capital if the drop continues, but you're also positioned to ride the next wave when fundamentals realign. Now let's pivot to the day's earnings headline. Adobe reported a 13% jump in quarterly revenue, driven by its Creative Cloud and Document Cloud subscriptions, yet the stock is down 23% for the month. That divergence is a classic earnings price lag scenario. The company's earnings per share grew 19% year-over-year, and its subscription revenue churn is at a historic low of 5%, meaning customers are staying. The dividend yield is modest, around 0.5%, but the real pull is the robust cash flow that allows Adobe to buy back shares. Over the past 12 months, Adobe has repurchased roughly $10 billion of stock, which supports the price when earnings are solid. What does this create for a disciplined trader? First, the stock's price-to-earnings ratio sits near 30, which is reasonable for a mature software business with high margins. Second, the recent pullback gives you a potential entry point that also offers an income tilt via the modest dividend and the likelihood of continued buybacks. A safe way to play this is to set a limit order around $450. That's roughly a 12% discount to the recent high of $510, and to consider a protective stop just below $400, which is the 200-day moving average. If the price respects that floor, you're likely holding a high-quality asset that can weather short-term volatility while still providing upside as the broader tech sector regains momentum. Let's hear the bull side. Proponents argue that memory demand is still in its infancy. AI model training is exploding, data center capacity is expanding, and new applications like generative video will need more memory bandwidth. They point to the fact that the U.S. Treasury yields, while higher than a year ago, still leave a spread that makes equities attractive on a risk-adjusted basis. For AMD and ARM, the belief is that the AI premium will keep the multiples elevated because investors are willing to pay for exposure to the next wave of compute. The bear side counters with the same numbers we just walked through. Overextension, high PE ratios, and a macro environment where rates are sticky make it hard for the market to keep rewarding speculative pricing. The inventory data for memory chips shows a surplus that could persist into next year, and the AI hype, while real, is still being priced in. When you factor in the Fed's hawkish stance, the cost of capital for growth companies rises, and the margin for error shrinks. Weighing those arguments, the evidence leans toward caution. The fundamentals for the